So the first question here to you guys in your perspective, and I think Ali might be frozen a little bit. No, he's back. Okay. What makes India unique in terms of economy, in terms of population, education? What makes India unique as a space to invest in early stage startups? And I suppose we'll start with Aniket because you're, again, unmuted.
Sure. So I think you covered it briefly in the beginning. So the population, I think, plays a large part. We have 1.3 billion people, and interestingly, with regards to the population as well, the demographic is such that I think we have over 60% that are under the age of 35. So therefore, the productive part of the population, not just right now, but for the foreseeable next 10 to 30 years or so is positive. So we've seen or heard of stories of countries like Japan, for instance, where a lot of what they built in the 70s and 80s, now a lot of that population has aged, and therefore a lot of the services, products, etc., should probably be catered to a aging population. Whereas the domestic demand itself and the productivity side of it in India, I think that way is fairly synchronous in nature. I think another thing that gives India an advantage specifically is around language itself. So English is predominantly spoken for all business conducted here, right from the government level to private and public companies. So that gives us an advantage and also sets us up well to interact and do business with countries with other countries specifically. And also the obsession in India specifically with engineering per se is, I mean, again, unconventionally, I'm not an engineer, but majority of the people I work with are largely engineers, and engineering forms the base of the country. Every high schooler, middle schooler is sort of ingrained that start doing engineering or look to do engineering at some point in time. So therefore, the technology base that has been created or the talent pool that has been created to cater to any sort of technology developments is fairly strong. So we've seen, therefore, a lot of work coming our way in the last 30 or so years, like I think Ali had pointed out from when the economy had opened up in the early 90s. And that, I think we're seeing a lot of the benefits of that in the last 10 years. So I was also just looking up some numbers, for instance. So specifically, if you look at the last 10 years, when you compare India with the other BRICS countries, 8 of the last 10 years, and we had, of course, 2 years of the pandemic in between, 8 of the 10 years, India had upwards of 6% growth rate on year GDP. China had 7 out of those 10 years above 6%, and Brazil, Russia, and South Africa had 0 years above 6%. So that automatically shows that a lot of growth is happening here. Now, we know that there are reasons for it. I mean, China, you could say, actually took off from, I mean, the last 20, 30 years have been very productive in China, but now you're seeing a little bit of a slowdown in terms of growth. At least you're seeing single-digit growth numbers rather than double-digit. Russia, as we all know, has had a lot of geopolitical factors that have contributed to their economy not growing, or at least not being sort of attractive enough for business to take place with other countries. Brazil and South Africa have seen more of moderate growth rates. Maybe the time will come for them to take off as well. But I think we're in that decade and probably in that quarter of a century where India is poised to do really, really well. And even with setbacks such as the pandemic and the recession that happened in 2008, I think India's bounced back from a lot of these things faster than what you would probably see in the Western countries, and also what you're seeing in some of these developing countries.
True. And if I may add, I think a lot of points have been covered by Aniket and Alicia in your slide as well. So there's, the digital part, the population, the startup ecosystem as well. And I think a couple of, more things I would just like to add is, apart from these, I think what underpins even our, investment thesis is a couple more points, which one is, the technology transformation, which is happening throughout the world, is leading to huge opening up of the opportunities in India, in the sense that using that technology and solving it in a unique Indian way, I think is becoming more and more possible. Indians are known for what is known as a jugaad, which is I would say more innovation, but of a very local type, And that, I think that spirit is very strong, and the new technologies are opening up that opportunity. And the second is also which is a fallout of the population and growth, is the growing size of the middle class, which is very aspirational, which is traveling around the world, which has lived across the world in many cases and come back to India expecting new solutions, new technologies, the way they've seen it across the world as well. And I think this is the opening up of the mind to adopt and adapt to new things. And those are equally playing a big role, especially in urban India, but now more and more in rural India as well. Because rural India has fantastic penetration of, in fact, one great thing is the cost of telecommunication in India is dirt cheap, right? And I think that is the foundation for a deep penetration of, you can call it mobile phones, even smartphones, not only in urban India, which is pretty much fully covered, but also rural India. And that opens so many opportunities for startups as well.
Thank you. That's very interesting context. One thing that's interesting to me, when you guys mentioned I think you called it the session with engineering, where do you think that comes from? Because I think that's noted from people not within the country as well, that there's a very strong, I don't know how to call it, propensity to go towards engineering, go towards more technical skills, but also, that plays out in, people becoming doctors at a higher rate than average, at least here in the States, when they kind of immigrate and then they're doing really high level professions. Is that just a cultural phenomenon, or was there a concerted effort somewhere along the way to start to develop the population in that fashion?
I think it is definitely historical. A lot of efforts have been put in that way. I think after independence, there was a realization of the shortage of both technical and medical manpower, and the foundations were very much laid with the birth of the IITs, and which are the Indian Institute of Technology and the Indian Institutes of Management, etc. Right from the 1950s and 60s. And I think, then the obsession kind of just grew with regional colleges. And then now, of course, definitely, in fact, there are a lot more engineering colleges than there is demand right now. So it's actually spread to that extent that, the market initially responded very well, responded to the demand. And now, of course, people are now branching out into more liberal arts and humanities as well, which is very late realization in India, I guess. But engineering and medicine are pretty much what, every kid for the last 50 years, I would say, were their top two choices. Aniket, you want to add anything there?
No, I think you've covered all of those points. I think that's exactly how I resonate with it as well.
Okay, thank you. And then maybe that leads me into our next question about sectors that are particularly important, or any that you would like to call out specifically to any particular startups that you think are really interesting, or doing things that are pioneering in a certain industry, or any just industries in general that you guys find very interesting that you would like to speak about.
Sure. So specifically, I think, so we've established that technology sector in India is growing, and that comes from, I think we spoke about a good engineering base and the English language proficiency. I think one more important thing to note is the cost arbitrage that India enjoys. So right from the early 90s, we started seeing a lot of work that would have happened, let's say, in countries like the US, being sort of outsourced to India. So it started off with IT services firms sort of taking on a lot of those projects and doing it for a fraction of the cost. So it was a win-win for both. India was obviously generating jobs and income for people to the level that people hadn't seen, and for countries like the US, of course, it was a good sort of impact on the P&L of the work that they did. But so that itself has evolved. So right from the time when it was just services largely sort of outsourced to, we started seeing a lot of these big tech companies also set up R&D units in India. I wouldn't say even as of the early part of the 2000s, we didn't see a lot of product work happening here, but engineering slowly started coming here. So for instance, I think companies like Microsoft in Hyderabad have their second biggest campus here right after the one in Seattle. So so that sort of showed that the talent here could be utilized for a lot of those things. And then in this decade specifically, or actually starting from 2010s, we are seeing that a lot of product work can happen here. We as a fund, I mean, when you speak about specifically startups, we as a fund are betting on that. We started seeing a lot of B2C related growth in India because, of course, 1.3 billion people means there is a large consumer segment. But we believed that a lot of the hesitation or apprehension that companies in the West had with regards to giving away core product work to India would change in this particular decade. So we set up the fund in 2016 specifically to fund B2B product companies from India. So the idea is to build B2B products in India because we believe the ecosystem is right to do so, but look at a global mindset from day one in terms of selling it. So we aren't building B2B products for the Indian market alone. It's largely for a global market. And if India is a byproduct of that, that is great. But we know that product and engineering needs to sit out of here. And so we're seeing advancements in many, many different sectors. It's a good opportunity for me to plug a couple of startups that we've invested in that I believe are sort of making good breakthroughs. So one of them is a company called Ambi. Ambi takes climate data specifically publicly available. So they started off actually being a sensor-based company where they installed about 500 different sensors to collect climate data, but they believed or they realized sooner rather than later that that's not a scalable way. So they largely rely on publicly available climate data. It could be weather data, air quality, pollen, etc. And they use their sensor data, use some of the publicly available data, and then their IP lies more or less in the models that they've created to predict at a very, very accurate basis what hyper-local data for something like this could look like. So I'll give you a use case. So Nike, for instance, is one of their customers, and Nike has its running app where you as a runner, if you are tomorrow, let's call it in Bombay, in India, and you want to chart out a running path which is sort of healthier from an air quality standpoint than something else, Nike can actually prompt and say that take this particular route because this particular street, and it goes down to the street level, this particular street has, let's say, better air quality than the next street. And this sort of data, you won't get it from existing sensors out there. This is largely basis the models that they have used. Another company in the hardware space that we invested is a drone company called Oculo. Typically, drones have, I mean, because of the payload that they need to carry, they have a flight time of roughly about 60 to 75 minutes, depending on the battery that they use. These guys have managed to engineer a product that can go up to 7 to 8 hours, and that's largely because they've installed solar panels on the wings. So these are fixed wing drones with solar panels on the wings to enhance the flight time. Now, the use case for this could be something like patrolling of the borders. So we have a lot of India specifically has a lot of border parts that are quite difficult to get to because of the mountain ranges or because of the deserts or the water bodies that exist. So this provides a good use case, and we're seeing bodies like the Defense of India sort of pushing for startups to provide solutions that they could end up using. Or even oil companies, for instance, they have thousands of kilometers of pipelines that need to be monitored rather than having stations set up at every interval or so to monitor some of these pipelines. Drones of this sort could be used. So we invest fairly early at some of these stuff. So Oculo, for instance, the product wasn't ready. Ambi had some use cases, but they've seen use cases specifically on the pharma side where supply chain of pharma companies could be dictated by a lot of the insights that the climate data or by a lot of the insights that is being shared by a company like Ambi. So I think these are some of the interesting companies, and we continue to see many, many more.
Thank you. Ali, anything you would like to add on that?
Yeah, thanks, Aniket. Yeah, I think, what I would like to also bring to attention is the use of technology in more functional or sectoral applications, and that the kind of opportunities that has opened up. See, India is a really massive country, right? So even, ideas, you can really experiment, and the variety it offers, the kind of geographical linguistic mix which is there. So when ideas are put out in the market, they really get thoroughly tested, right? And that builds very robust kind of outcomes, right? For example, and also especially in areas like health and education and even consumer, this really plays out, very well for us because, for example, if you look at a couple of our edtech companies which we've invested in, the kind of numbers are just mind-boggling. There's a company called Convigenius, which has actually brought technology into the public sector education system in India, which was actually the last frontier of actually applying technology. It has 150 million plus users, and another, of our companies in the career tech space called Internshala basically gave birth to the internship market in India, connecting students from colleges across India to companies looking for interns. And even here, it's like 21 million students active and 300,000 jobs. So the scale at which your startups even get tested is just kind of fantastic. Even and also in traditional sectors, consumer sectors, right? We have where technology is again playing a very, very important role. One of our investments in a fish and meat company called Fresh to Home. Again, Fresh to Home is one of the largest such companies in India. And they have built the tech platform serving 3,000 fishermen across 300 cities, coastal cities or towns in India. So imagine the kind of scale which these ideas get tested, and I think that's really unique, about India as well, which often so ideas which emerge successful out of here should be pretty much applicable or plug and play in other parts of the world just because of the sheer diversity which they've been put through.
Yeah, I think that's a great point because we don't, especially because there's a density in, not only is the population very high, but there's a density in India that's not like anywhere else, save a few spots, right, in the world. So I think that's a great point. I'm gonna skip a couple of the questions that I had sent you guys originally, just because I want to get to a couple of the later questions. Let's talk about risk management a little bit. And that's because I know that we have a few other investors on the call, and I think some of them are interested in like risk mitigation, both that you guys, strategies that you employ as firms for risk mitigation, but also what you would suggest to people who are interested both as angel investors or VC investors in entering the country. There's a number of firms that I have talked to that most of them, I think, based in the UK, and I think there's the historical interest there, that are interested in entering India, and there's a lot of startups and things, people that are just, they recognize it's a huge market somewhere to be generally involved, but there's a lot of uncertainty there. So any thoughts that you guys have on risk mitigation, both inside the country and entering the country, I think would be really interesting to talk about.
I probably go first.
Oh, please.
And yeah, so when it comes to risk mitigation, I think a couple of things do stand out. Definitely India is an emerging market and comes with emerging market risk. There is also, exchange rate risk, which comes because, at the end of the day, whether it's a dollar or a pound, it's finally invested in a rupee and will have to be sent back, in a dollar or a pound, which effectively entails that the exchange rate risks are very much, apparent. But there are definitely, the growth which companies the pace of growth of both company revenues and valuations should take care of those aspects from a exchange rate risk point. But a couple of things, the regulatory structure in India has been made very robust in the last 10, 12 years for alternate investment funding, right? The rules were changed in 2012, came about in 2014. They were passed by the parliament. And so the Indian structure is similar to global structures of having an independent trustee, a regulator, and then the whole works of having an investment manager, a custodian, and your depository. In fact, the latest rule is that all the units have to be demonetized to be put in the depository as well. And so a lot of these steps our regulator SEBI has put investor protection as its primary goal, whether it's an Indian investor or a foreign investor. The foreign investors are treated on par with Indian investors. The tax laws have been made very clear, and that again has added to a lot of comfort for foreign investors as well. Because that's the primary thing, right? Regulatory clarity has really helped. And also one challenge which early investments faced was about exits. But recently we've had, companies, giving back returns, AIFs giving back returns to foreign investors as well, because that part has also been tested now. So from that part of it, I think a lot of challenges which foreign investors would face have been addressed. I will talk a little more about what we as investment managers do for risk management, but maybe Aniket can add a little more on these aspects if he wants to.
Sure. Thanks, Ali. No, I think those are some really pertinent points that you brought up. I think even in terms of it's not as straightforward. I mean, even as so we are, for instance, in our second fund right now and are about to start our third fund next year. Even in terms of our fund journey to get the approval process, although we have two funds or close to 9 years of track record behind us, it's not as straightforward. So we need to showcase that we are fully vested into what the fund seeks out to achieve. We need to ensure that we will follow certain guidelines set forth by the SEBI, which is the equivalent of the SEC in the US. And I think outside of that, we will each fund manager ends up having. I think Ali was also going to go towards that, but ends up having their own sort of risk mitigation strategies. So I think it also depends on the risk appetite of the potential investor coming in as to how much do they want to get in. And I think some good points that Ali brought up were around how we are seeing a lot of exits being made possible for the startup ecosystem now. So if you want to invest, for instance, in an early stage fund, obviously you need to invest with a long time horizon in mind, typically a 7 to 10 year structure where you know that it may take up to 10 years for the money to come back. But now as more and more IPOs have happened, we see that funds are being specifically set up just to invest at the pre-IPO stage. So you could then get a return in as little as 3 to 4 years. So they know that so-and-so company is going to go public in the next year or two, and they sort of block allocate capital to acquire those shares at a discount to what the company would eventually sort of list at, and returns would come in, and returns could therefore are more sort of not guaranteed, but I would say the risk level there is a lot lower. It may not be as high as, or the returns might not be as high as investing very, very early, but depending on the appetite of the investor, you could get in at that specific stage. For a fund like us, because we invest very early, we typically write the first institutional check to a startup ranging between 750K to about $1 and a half in USD. We primarily evaluate each startup that we invest in on 4 parameters. So technology, adoption, capital, and execution. Technology for us specifically is the easiest because we are a tech-focused fund. The background of most of the people here is largely in the tech domain, and we'll only invest in areas that we understand. So when I said we only invest in B2B and not in B2C, it's because we don't believe we can add value or we understand how the B2C ecosystem works. So that way we mitigate some of the things on the technology side. Adoption is a bit harder because we invest most of the 70 or 80% of the investments that we made have been in companies at a pre-revenue stage. So therefore, we get excited by the product that we are investing in and the team that is building it. But is there really a market for it? A lot of it we'll need to try and figure out while we evaluate a company. So we end up speaking to a lot of potential customers because there are no real customers to speak of. There are no financial records to go by in terms of what the company's been generating in terms of revenue. Projections don't mean much if we don't really know if there's going to be a product market fit per se. Capital risk is again an important thing. So I think a lot of times an entrepreneur ends up underestimating how much money they will need. And I think the single largest reason a startup fails is they run out of cash. So we hear a lot of what would I call it? Premature thoughts that come in from an entrepreneur that says that, hey, you know what, I'm only looking to raise 500K now. I want to go back into the market in 4 months to raise a larger round, for instance. Now, we know the difficulties of doing so because typically fundraising takes a lot of time. It could take 6 to 9 months of your time to do a good round. So if you want to be in the market every 4 to 5 months because you don't want to dilute too much, you're actually not doing your startup any good. I mean, I'm obviously taking an exceptional case here, but realizing how much capital they need, is that enough for us to want to fund something? And I mean, we're all talking about AI. And AI, let's say there is a company in the AI infra space, which potentially needs a lot of capital to begin with. If somebody says, hey, you know what, I'm only looking to raise 200, 250K, we try and assess what milestones will that lead them to, and is that actually enough for a Series A investor down the line to be interested? Because those are those are the milestones that we set. What is it that we can do at this point in time for a Series A investor to find the startup attractive, let's say 18 months down the line? And the last thing is execution. Again, a lot of the ideas that, or companies that we end up speaking to, are at such an early stage that everything on the paper and on the deck looks good, but what's their ability to execute? Again, we end up speaking to potential customers. We try and dig deeper into their track record of seeing operationally how have they been able to execute on some of the work that they did in their previous organizations, and accordingly sort of rate them basis that. So I think each fund would differ in this. I'm sure Ali would have a lot of similarities in this, but also some things could be unique to the way they operate.
Sure. And, thanks, Aniket. I think, yeah, quite a few, having worked in India, this is a place where, we are focused on, we look at companies who are operating in India because we understand it well. And again, sectoral focus is very important. We do not believe in the spray and pray approach. So, I mean, I think, we've seen what, more than 2,000 opportunities so far. We liked around 100 of them and finally ended up investing in 12. So that's the scale of filtration done. Obviously, it's a lot of work, but I think a couple of few things I would like to add. One is from a risk perspective, how do we reduce risk for investors? I think one is sourcing the deals itself. I think the founder track record, knowing the founder, or making sure that you do thorough checks, because we don't want to be in bed with not so good founders. So I think that's a very, very critical part. It's easier said than done. And the other aspect is actually doing a very strong diligence. I think even you'll find VCs, including us, almost doing, maybe I won't say, but very close to PE level, diligences, because you really have to dig deeper, and that entails more time for every deal to close. Especially we do rely a lot on experts and our own general partners who are sectoral experts. Their vote is more important. And then, of course, the client feedback, because, founders being founders are definitely, their business plans and are quite far-fetched. So pinning them down, like Aniket said, how much money do you need? How long do you think this money would last? So getting a strong, tight business plan is, again, very important right at the beginning, before our money goes in. And, because I think those are aspects before investment. Of course, post-investment, I'm sure many, VCs would do this, but very critical in India, especially, is ensuring that, your conditions precedent, conditions subsequent, legally, what the changes have to be done, and put it down and ensure that happens, taking up board seats and sitting and ensuring governance structures, because both I think IdeaSpring and Mount Judy Ventures are at the pre-Series A, Series A stage. So we are typically the first institutional investors. So it's the first time the founder actually encounters boards who are external to himself or themselves, right? And so I think that is getting them used to an external governance system, making sure that they go through the processes, understand what it takes to grow their company from a very small one to preparing them for much larger play. Is strengthening governance is very, very critical there. And I think VCs like ours are playing a very critical role there, and we need to play a very critical role there. because we do so often come across governance lapses which lead to downfall of many a startup. And of course, the other things are holding affirmative rights. But more importantly, also in India, I think helping those founders, to expand geographically, to connect to new clients, new markets, providing support in hirings. So we are actually becoming more and more their 2 a.m. friend. Any challenge which they face, we as venture capital investors are needing to play that role. And obviously that reduces our risk because we know intimately what's going on with the company. We get early signs of danger and get a chance to correct it as well. So these are some of the things which I think, apart from the regular MISs and those things which most investors do. But I think here in India, you really need to put little more teeth, a lot more effort to make sure that your investments are being handled well.
Hmm. Yeah, that makes a lot of sense. And we actually have a question about that in the chat about how does a foreign angel investor ensure that they get a return on their investment. But maybe in addition to that question, how robust is so you've got like obviously different categories of where you could invest. If you were to recommend, so say I'm a foreign angel and I want to invest, $20,000, right? Would you recommend that I put that into just crowdfunding campaigns, find an angel group to potentially join and deploy some money, find an early stage venture capital company like yours to be an LP on their cap table? What would you recommend as the best path, the best strategy to kind of entering and getting more familiar with the market?
See, again, the good thing in India, like I said, the regulations are very tight and very necessary to be tight because, and the AIF's ecosystem has actually done that fairly well. So we have a category 1 license where, for a regular VC fund, the minimum ticket is around, $120,000 for a normal venture capital fund. But there's also this angel category where the minimum ticket is 1/4 of that. It's around $30,000, and to be invested over a period of time. It's not that it's a one-time investment, right? So here the typical way these angel platforms work, and ours being one of them. Our second fund is an angel platform. Our first fund was a regular VC fund. So in our angel platform, basically vetted deals are brought to the platform. We present them to the investors who signed up to that platform, and they take a call whether to invest or not. And the minimum investments are in the ranges of maybe $2,000, $2,500 even. But the minimum commitment is that they would invest that $30,000 over the first 4-5 years of the investment period of the fund. That's a very small ticket size, bite-sized level, which investments have been brought forth in India. And there are many platforms, there are many very large platforms as well. But these are very well regulated as well. Quarterly reports to the trustee and to the regulator, annual reports, valuation reports done regularly to give transparency to the investors. So, which would be definitely better than to be a small investor directly into a startup where, the founder may not have the time and the ability to, kind of provide that much information, etc. Whereas these the angel platforms and the VC funds in India, who are fully that's their job, right? So I think it's wiser for foreign investors to come in through the alternate investment fund route because these are very well regulated. The regulations, both from a taxation viewpoint, from a legal viewpoint, from a investor protection viewpoint, are fairly good.
Yeah, I agree with all that Ali said. I think the only other point I would add is the exits, although we painted a good picture saying it's becoming more and more attractive in India and possibilities do exist, it is still hard. And having invested personally in startups on my own and being a part of a fund and investing in other funds as well, if you invest directly in a startup, the startup hasn't taken off, for instance, but let's say it's not dying either. It continues to sort of sustain at a slow pace, but not attractive enough for anybody else. It's quite hard to get an exit. So therefore, sometimes when you are piggybacking on an institutional fund and investing through the AIF structure, which is an alternate investment fund, Yes, your ticket size, at least into a VC fund, is slightly higher. Like I think Ali was saying, it's about $120,000. But you do know that there is a professional management team that is also looking at ensuring that liquidity comes through. And there is pressure being put by the regulator, which is SEBI, to the fund that the 7 to 10 year horizon that I spoke of isn't just an arbit number that the fund manager decides. It's actually regulated and enforced upon. Every year that you go over and above that, it is sort of detrimental to the brand and reputation of the fund itself. Yes, you can seek extensions and that can keep going on and on, but it's not ideal. So there is pressure or a time clock sort of ticking down for a fund manager if they take money from LPs. Whereas if you've invested in a startup directly, a lot of that is harder, especially if you don't have a lay of the land, the ecosystem here, and can't really sort of do much to be a part. So it's likely, and I could be wrong in my assumption here, it's likely that your involvement coming in as a total outsider, your involvement in a startup might be more passive to begin with. And as you understand the ecosystem, you may want to be more and more active. So a good passive route is through funds. And as you get more active, you could transition to the angel platforms and then eventually sort of invest directly into startups yourself.
Okay. Thank you. Thank you. And last question for me, because I want to take a few of the questions from the chat, but is there any rise in secondaries trading in the country inside? And it occurs to me that a few of the funds that I've talked to that are based in Africa, for lack of liquidity for exits, there's a whole sort of layer of secondaries transactions that are starting to happen where VCs and angel groups are selling their equity that they bought really early stage. Company's grown, and like you referenced, it's not really gotten to the point where it can exit successfully. It's doing some cash flow, but it's kind of just in the middle, doing well, but not bad enough to shut down, not good enough to sell. And then therefore the secondaries market is starting to develop. Is that something that India is seeing, or not quite yet?
Not very evolved, to be honest. I think it happens, it doesn't happen in a structured way. Like I'm aware of funds abroad that specifically that USP is to sort of buy shares from the secondary market because you can get it at a discount. In India, I don't think that ecosystem is actually alternate forms of investment itself in India are only sort of picking up now. Until some time back or up till a decade or so back, the only form of investing into startups was through traditional sort of venture capital, but now you're seeing a lot of debt financing, revenue-based financing, and then potentially secondaries, etc., also could come in where it doesn't directly go to the startup, but at least provides a good exit ecosystem. I think you're seeing even ESOP buyback, which actually helps increase the pool of equity available and that can be distributed, is becoming a concept that's that sort of attractive only. Now, to give you an example, I mean, of the 2-3 startups that I've worked in as well, when I started working, a lot of times in India, when you negotiate a salary or a compensation to start working in a startup, even if startups used to offer something like ESOPs to you, it was very, very devalued because you never knew how you would ever get money from that. So you'd see in India that a lot of the short-term rewards or short-term benefits that you can get out of compensation, you would rather push and negotiate for that than wait it out and hope that you get equity that could come through your way at some point. But I think the people realize that that's not a good sort of long-term strategy for the company, and ESOP buybacks is becoming popular. So I think you're seeing more and more ways by which different players in the ecosystem can get some sort of liquidity. Secondaries, in my understanding, is still not evolved as yet, but I would think it should sort of mirror how it has sort of evolved in the West as well.
I think very recently we've seen the first couple of secondaries only funds being launched. It's very, very early days, for that. But it's a great sign for the market that, there are secondaries only funds being launched in India. Very recently, I think one of the Peak 15 partners exited and started a secondaries only fund focused on India. And there are also these large family offices. Again, family offices are growing their presence in India. I think that also creates good opportunities for secondaries or exits as well, because they'll be always these are on the lookout for getting, create a lot of liquidity for investors, as well. The other thing is in India, the IPO market is again starting to look up. IPOs have been, some of the IPOs have been very successful. I would say more IPOs have been successful than not. And that's a very good sign as well. Startups are increasingly now, looking at IPOs as a valid option again, after the downturn, which has been bugging the market for the last couple of years. And also India has a SME IPO category as well, where even, smaller startups which, do not reach the sizes of the main bourses, but still there's a separate category called SME IPO, which they can undertake as well. So a lot of startups are also actually exploring these as as options for creating the liquidity as well.
Okay, thank you both. I'm going to, as promised, stop the recording quick